Hey, thank you so much for joining me. This is Mr. Market. We're now into episode 29. So today I wanted to go talk about the investment strategy that's been beating the market. It's been beating the market in August, which has been a pretty horrible month for the market. It's been beating the market year to date, and it's been beating the market ever since we've been starting it back in July of 2022. Now, I'm not talking about dividend growth investing. I'm not talking about small cap investing, international investing, or large cap growth investing. I'm talking about a strategy that actually kind of mimics a little bit of what made Warren Buffett a billionaire. And you know how he got very wealthy? It was because he was selling insurance products. And what we are doing is pretty much doing the same. We are selling insurance on the stock market. We're basically selling fire insurance on the stock market, pretty much hoping that things don't burn down. And the way that we've been approaching it is through something called selling put options. So the strategy basically goes like this. Imagine we are playing a game of keep away with the stock market. And the stock market is this burning fire. And we want to be as close to the fire or as close to the market as possible without it touching us. And that's basically it. So what are the most important variables in this case? We want to be looking at how close this fire is to us and what the direction of the wind is blowing. So is the wind blowing toward us? Is the market falling? Or is the wind blowing away from us? Is the market rising? And pretty much all we're doing is we are adjusting our location to see how close we can get to the market without it burning us. That's basically it. So it's really important for you to establish some sort of trading system or some kind of trading process that keeps your emotions out, and so you can think clearly about how to assess the market. It's good to take a look at economic figures. It's good to take a look at the earnings reports, everything that you can read. But I think it's important, most importantly, to take a look at the price and the volume and the trends. And all those economic factors that we read about and think about and hear about all show up in the stock price. So it's really important to focus on that. And we do this on a weekly basis. And the strategy has produced some pretty amazing numbers. This is a live test that I've been doing for the past year plus, and I've been doing it in the bull market environment. I've been doing it in the bear market environment. Over the past year, going back in July, we've had pretty much what resembled a full stock market cycle, where you had very bearish sentiment followed by some very bullish sentiment. And even through all these periods, the returns have been quite robust. And so I'm excited to go show you some of the results. This is a strategy that I think can continually produce good returns, provided that you are controlling risk. And I cannot emphasize enough how important it is to go manage risk with a strategy like this. Because, if we are selling fire insurance on the stock market, it's like selling fire insurance on a house. So whenever there's a fire nearby, your fire insurance premiums go up. And so that means we have a greater potential to go make money, but we also have the greater potential to lose money. So a really important point in this approach is that if you're going to be magnifying your risk, you also need to be magnifying your risk control methods. And so that is probably what sets apart the successful investor that uses this strategy and the average to below average investor. It's all about risk management. So I wanted to go show you some of the results, and I think you'll find it very interesting. So for this first chart here, we have a graph of our performance relative to the bond market and to the stock market. And August has been pretty rotten for the stock market. It's currently down about 3.9%. But for us, we've actually been able to go make money. We're up about 1.3% so far. And our ability to set strike prices at levels below the market, where there are existing support levels, has been pretty much our primary secret for making money this month. We want to set our strike prices at areas where there's support, because when the market dips, that's where traders are looking to go buy. And usually that buying pressure buys us just enough time to let the investment contracts expire worthless. Now, this month, we've had a couple situations where the market dipped below our strike prices. And like I mentioned before, we need to be very disciplined with how we control for risk. So whenever the market falls below my strike price, I will take the loss and I will roll down further in order to reduce my exposure to further losses. And every once in a while, like it did this month, it goes into our strike price and then bounces back. And that is just the price of being disciplined. And I mentioned in my previous episodes, there's two types of pain that you'll experience. You will experience the pain of regret or the pain of discipline. And we choose the pain of discipline in order to avoid the pain of regret of experiencing a much larger loss. So for this month, we've done pretty well. The maximum drawdown for this month for the market was 4.7%, while ours was 0.76%. And our Sharpe ratio has stayed fairly consistent above the 2 level. It's at 2.72, while the market had a negative Sharpe ratio of 4.97. For this next chart here, we have the year-to-date results for our strategy. And a couple of weeks ago, we were still underperforming the market because it was just on a runaway train. But as the market fell lower, our defensive strategy has allowed us to take the lead. So we're up currently 16.96% for year to date, while the market is up 15.92%. Ever since we've been doing this strategy in July, we're up 35.79%, while the market's up 18.55%. So across multiple time periods, this approach has given us higher returns with lower risk. And that is pretty much what I think is the holy grail of investing. If you take a look at all the performance metrics that matter to me, look, the year-to-date returns are higher, the Inception returns are higher, our Sharpe ratios are significantly higher than the markets. We're roughly at about a 3 for the Sharpe ratio, while the market has oscillated between about 0.6 to about 1.5. Our maximum drawdown is significantly lower. We're about half the market's drawdown to about 75% lower. Our standard deviation is about half the markets, and our positive periods are floating at around the low 70%, while the market is floating at around the mid 50%. So on all these metrics, we are significantly doing better than the market. So far, the strategy that we've been using has a win rate of about 85%. And that is, I'd say, a very, very good number. The average investor probably has a win rate of somewhere about 50 to 60%, and that's considered a good investor or a good trader. So to get something in the 85% range is, I think, pretty phenomenal. And as you've seen, the numbers look really good. So I think this is a strategy that has some validity to it, and I am planning on continuing to use this to reach my investment goals year after year after year. So let's take a look at what the stock market is doing. As you can see, we had that breakdown from that first trend that happened at the beginning of August, and then in the middle of August, we fell below that second trend. And so the market's been continuing to deteriorate, and it's now below the 50-day average, which is an important metric. One thing that I've noticed is that all bad things happen below the 50-day average. And so this is an area that causes me to be a little bit more cautious. But also we did see a rebound on Friday that brought us above the 9-day moving average. And so I'm willing to continue to hold my strike prices at $430 and below, just because you could have a little bit of a relief rally. We've had a little bit of an oversold condition, and that is usually enough to buy us a little bit of time to let our investment contracts expire worthless. One of the charts I'm looking at is the inflation numbers, and we're starting to see a little bit of a pickup in inflation again, which is going to be a concern because the Federal Reserve is always watching for signs that inflation may kick back up again. We've been seeing a lot of numbers that suggest inflation has been falling, But now we're starting to see some numbers that inflation may be starting to rise again. And if that happens, the Federal Reserve will have some more ammunition to go raise interest rates further. And that, I think, is going to be one of the biggest weaknesses for this market. So far it's been pretty unstoppable. We've had good jobs growth. The economic numbers have been fairly positive, but we're also starting to see some lower, payroll numbers. They're starting to go fall below expectations, and we still have a pretty healthy savings rate. And I think that's possibly what's propping up this market as well. But there's an expectation that these accumulated savings will eventually run out at the beginning of next year. And once that happens, things could probably become a little bit more problematic. The continuing jobless claims, they are still lower than levels that would trigger a recession. But if we look at the relative levels for where they are in 2023 versus the past 3 or 4 years, they are above trend. So this is something that I'm continuing to go watch. There's going to be a lot more pressure from higher interest rates. As you can see here, the monthly mortgage payments for the average homeowner have gone up significantly. Back in 2020, it was just at about $1,000, but now because interest rates are higher, because housing prices are higher, the average mortgage rate is now over $2,300, and that is just not something that can be ignored. It's going to add pressure to the consumer's pocketbook, and it's often said that the consumer makes up about 70% of the U.S. economy. So at some point, this is going to spill over into the spending patterns. And that's what I'm starting to watch out for. And so far, we haven't seen too much of a dent on the consumer, but you're starting to see some weaknesses in some of the retail names. So it's starting to creep up there. And as this growing fear that we might go into recession grows, the market sentiment about the soft landing may shift into a potential hard landing. If you take a look at the mortgage rates, they've been climbing over 7%. But this chart here shows that even though we have higher mortgage rates, the effective rates on the mortgage debt outstanding is pretty low, still at about 3.6%. And that's partly why, even though the Federal Reserve has been raising interest rates so much, it hasn't been affecting homeowners too much because so many of them have locked in at significantly lower levels. So, what does that mean? It probably means that they might have to go raise interest rates a little bit further. And I'm of the opinion that we are not going to be able to bring inflation down to their 2% target as long as the economy is continuing to grow. The Federal Reserve will most likely have to go raise interest rates beyond even this uncomfortable level in order to bring it down to 2%. As long as you have a growing economy, you cannot get inflation down to that 2% level. I'm going to say that again. So what's the solution? I think the unfortunate solution here is that they will have to tip the economy to a recession in order to bring that inflation number down. So I'm just watching out for that. And there is a gradually increasing sense that maybe that narrative may change. And we're starting to see it with the stock market, going below the 50-day average, seeing it fall into negative territory for the daily momentum indicators. So we're starting to see some signs here. Also troubling was Nvidia's earnings results. The results were good, but the market's reaction to it was not good. It had an initial spike, and then by the end of the day, it gave up all those gains. And then by Friday, it gave up even more of its gains and was actually down for after the earnings. What's important here is not so much the actual earnings themselves, but the market's reaction to those earnings. Whenever something behaves worse than you expect, that is a cautionary sign. If something behaves better than you expect, that's a positive development. And in this case, the hottest sector of the market is AI. And if that part is starting to lag, then that gives me a little bit of concern because, as we know, this market's being driven by about the top 7 stocks, and a lot of them are very tech focused. And if tech starts to break down, we won't be able to avoid that, at least for the overall stock market, because it represents such a large weighting. On the flip side, we have the next 12 months earnings projections for the S&P 500 continuing to climb, and there's a pretty good correlation with the market and the direction for these earnings estimates. So as long as these estimates are climbing, I'm willing to give the market the benefit of the doubt. But also, one thing that is concerning is that there's also a pretty strong correlation to the stock market's performance and the Federal Reserve balances. And as you can see, it started to disconnect sometime this year. As you can see, the S&P 500 has advanced while the Federal Reserve balances have been continuing to move lower and lower. And eventually, this gap will close. And if that happens, then there's quite a bit of an air pocket that the market can experience. So I am continuing to be a little bit cautious, and I tend to have lower strike prices for my options because of little risk factors like these. Also, we have something similar to the NASDAQ 100. The liquidity levels relative to the central bank balance sheets have had a pretty strong correlation going back 13 years, according to this chart. And as you can see, we have another deviation, and this gap could also close. And if that happens, the market could be in for some potential trouble. If you take a look at all the positives and combining it with the potential negatives, you end up having some cross currents. And historically, from August all the way till about November, the market just ends up trading sideways. And so, my best guess, we could probably end up doing the same thing over here, where you have some good news being offset by bad news and offsetting each other. And in the end, the market could just be trading sideways and not being able to decide which direction it wants to go break out. I also found this interesting chart from Bloomberg that shows how much time typically passes before unemployment numbers start to rise and the recession officially kicks in. And this one is a little bit more on the alarming side. Take it with a big grain of salt. The economy is still throwing around some pretty good jobs numbers, and until we get some sort of event that really triggers job losses, I'm not going to put too much weight in a chart like this. Short term, the sentiment has been pretty negative, and that has given us enough of a boost to trigger a little bit of a rally. But also, it's important to take a look at the overall big picture. The market's still in a negative downtrend. Now that we are below the 50-day average, we need to be doubly cautious, and any rallies tend to be sold. So, this is an area where I'm hesitant to add to positions on strength. This is something where if I need to take something off, I would be selling on strength. And then if I'm planning on buying the dips, I would tend to buy dips at levels below previous lows, because support levels tend to be a little bit more brittle in downtrends. So that's all I've got for today. Thank you so much for joining me. And if you haven't yet, please click like and subscribe so then you'll know when my next videos drop. Also, you can find me on the web at mistermarket.us or mistermarket.us. And also, you can email me at mistermarket247@gmail.com. So I hope you have a good trading week, and I will see you next time.